But focusing on the tyre space, we have JK Tyres, which is also doing quite well. In fact, we're joined by the management to talk about the recent increase in import duty on rubber prices and how exactly it would possibly even impact the company. Arun Bajoria, President JK Tyre, joins in to talk about that. Hi, Mr. Bajoria. Thank you very much for joining in today. First, what is your view on the hike in the import duty on rubber and how would it impact the industry?
It is a retrograde step with adverse impact on the entire rubber value chain and so also the tyre manufacturers. And moreover, this is in total contravention to the government's avowed position of increasing manufacturing competitiveness in the rubber sector. So I feel that politics seems to have taken the better of economics.
Okay, Mr. Bajoria, your point is taken, but could you quantify the damage specifically to a company like JK Tyre?
Well, altogether, I think the figures that we have from the Tyre Manufacturers Association that we import about 3 lakh tons. So it is an addition of 300 crores of rupees, and you can imagine that pro rata it will get distributed on the various tyre companies. So 300 crores is a huge impact. And particularly, you see, given the fact that we are already suffering from inverted duty structure, as we all know, the tyres can now be imported from ASEAN countries at 7% duty, complete full tyre, and which will go down to 6% after 5 days from 1st of January 2014. According to the Bangkok agreement, the duty keeps going down year on year. So you can import a complete tyre at 6%, but you have to import rubber at 20% plus 30 rupees. I mean, you can imagine what kind of a dichotomy this is.
Okay. But sir, taking the argument from the government side, their perspective is that since rubber prices have fallen dramatically due to the rise in imports, and that needs to be curtailed since domestic growers are getting impacted. So your view on that?
First of all, I would like to dispel this myth, if I am allowed to say so, that the rubber prices have come down. It is only, if you take last 9 months, I am talking of April 13 to December 13, the first 6 months, the prices of the local domestic suppliers, the domestic growers, was higher than the imported price. So let's be very, very clear on that. And it is only in the last 2 to 3 months that the prices were hovering around 155, 156, 154. So it's a completely a misnomer if we are trying to compare the prices and saying that the prices have come down. So really, I mean, you have to look after the industry. The industry is exporting 15,000 crores worth of tyres annually, and the competitiveness will be adversely impacted by these kind of measures. Anybody expects at least 5 to 6% return at the profit level.
Okay. What percentage of JK Tyre's rubber consumption comes from imports?
We import as a percentage, I would say that altogether, I don't remember exactly, but maybe about 25 to 30%, 20 to 25%, I think, 70%, 70-30 or 75-25, something like that, yeah.
Okay, Mr. Bajoria, just to clarify, will you be impacted by this move at all? Because many companies said that they pay zero duty due to the advanced license route. Is that correct?
I don't think that is true, ma'am, because even if you take the duty-free import, today, the RSS3, which is it will cost us something like 170 rupees, 170 even at duty-free. And today, after this, the prices which are now ruling, domestic prices, they are about something like, let's say, 173 or 100. So it's about the same. I mean, I don't think, I don't know how they made the calculation. Actually, all this has come on 21st night. Today is the 24th. We are just working out all the details.
Okay, Mr. Bajoria, fair enough. We'll move away from that now, focusing on the company itself. What about your margins? Because your margins had improved to around 10 to 11% in the first half of FY14. Do you think that's sustainable?
Well, we have been reporting profit margins at the operating margin level, that is the EBITDA level, of about 11%, 10.95, 11 to 12%. That's the average that's going on. Most of the tire companies are in this range of about 10.9 to 12.5 or 12.4, something like that.
So this would be the margin levels that you all will be able to maintain, right?
Well, it will all depend actually. See, today we are also reeling under the demand pressures, but we are managing because we are selling much more in the domestic market and we are also exporting a lot. And then our JK Tornel Mexico unit is doing extremely well. They've done very well in 2012. They've done very well in 2013 up to December, and we hope that they'll continue to do well in 2014. And we are also able to increase our top line marginally by concentrating more on replacement markets in India. So we should definitely do better in 14-15 as compared to 13-14. And there's another reason to it, that we have started our most modern world-class tire manufacturing plant, which is completely radial plant. That is, we only make truck radials and passenger car radials near Chennai. And that will now, that's completely on stream since last about 8-10 months. So this year again we will be able to get a lot of top line growth due to that.
Finally, what is the cost differential between the import duty on rubber and an import duty on a complete tire? And going forward, do you think it's more prudent for companies like yours to import a full tire from an ASEAN country as opposed to, deal with the hassle of a high import duty on rubber?
Many small rubber manufacturers have also become traders, in the sense that because it makes a lot of sense. So they are importing a lot of tires from various Chinese tire manufacturers into India. But we have not done that up till now. We do get tires made outside India. We have our outsourcing arrangements, but we export directly from there. And we don't add to this confusion and mess by bringing them back into India. But there are people who do that, yes.
Thanks, sir, for taking the time out and joining us. That's a very candid interview of JK Tyre's